But for more on whether today's data will move the needle for the Fed, we turn to Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, and also here on set with us, Stephanie Roth, Chief Economist at Wolfe Research. Welcome. And welcome. Andrew, real quickly, because last time we spoke, you were still pretty optimistic about markets and implicitly the economy. Do you remain that way?
Yeah, and I think if you look at the undertones of what's happening in the market is consistent with economy slowing but not breaking. You're seeing a rotation from the cyclical stocks to the growth stocks. But if the market thought the economy was really breaking, you'd see a rotation more into the safe stocks, the staples, the healthcare, utilities, and so forth. But we're not seeing that. So I think the market is, more or less validating what the Fed has tried to pursue, which is inflation down, economy slowing but not breaking.
Let me throw this out there for all of you. I'm laughing because Steve knows that I like to try some thoughts out here, and I think this is the right group to do so. Andrew, is it possible that AI is the business cycle right now? In other words, everyone's trying to figure out, do we look at things excluding the Mag 7, or from a trading point of view, do you stick with the Mag 7 and all the concomitant stocks that have been doing well? I mean, is it just possible that that innovation cycle is so powerful and the companies are so large that that is literally prolonging or more or less becoming the business cycle right now?
Yes, but I think there's other things going on that have not gotten focused recently, like fiscal policy. We're spending a lot of money, and that's going to help industrial material companies that are benefiting from that. The semiconductor equipment by the build out of the chip sector, which is different than AI.
Right.
So I think there's other things going on. It's just that really in the last month or so, it's AI sucked all the oxygen out of everything. But I would argue that that's a great setup going into earnings season, because I think a lot of companies can highlight how they're doing, even if they're not in AI. And I think a lot of parts of the economy are doing well.
Stephanie, I saw you nodding there, especially about the fiscal piece of it. How does that play into everything?
Yeah, fiscal's been driving a lot of the strength that we've seen so far. I mean, especially the chips build out that we just talked about. When we think about AI, though, it's really only driving about 0.7% of GDP compared to housing, which is 3 to 4, right?
Okay, all right. So Ed Leamer, that's what he used to say housing is the business cycle.
Exactly.
So it still is. That's still the overarching force in many ways.
Well, I mean, housing before the financial crisis was significantly larger than it is today.
Yeah.
But the point is that, sure, AI is super important for the market. It's important for the economy, but perhaps a little bit less so. So we have to still pay attention to the cyclical parts of the economy, manufacturing and leisure. And by the way, the immigration trends are super important today as well.
So but this is kind of where I'm going with this. So the ISMs, which I think a lot of people missed this week, being a holiday week and all, the manufacturing one, bad. It's not third month straight. It's still in contraction. Then the services one, as he was talking about, comes out Wednesday in contraction territory. So what is that telling us about what's going on with the economy? It doesn't sound like a picture of strength right now.
It certainly isn't strength. I would say we're losing some momentum, but some of the survey-type measures like ISM tend to capture momentum, right? They're not measures of absolute levels of activity. So it's telling you things are slowing down, and that we kind of saw that in a lot of the data, and this is just gives us the ability for the Fed to be able to cut in September, which is our base case.
So the mid-cycle supportive cut, the kind of nothing's a disaster yet, we're not starting. I see Andrew nodding with that as well. Steve, what would you say?
I need to warn people, I am objectively more subjectively optimistic on Friday afternoons.
So because you see the week,
it's just
especially in the summer.
Especially in the summer. But here's the deal: if AI is the business cycle, and warning, I don't cover stocks either, but I do sort of think about macro things. If AI is the business cycle, these are very early days in the AI business cycle. I have been fascinated by the focus of the market on the inventors of the stuff, and very little focus on the users of the stuff. If Wall Street has this entirely wrong, that's one scenario, which is possible. Maybe the tech ends up being a bust. If it's not a bust, they're putting an awful lot of capital into companies that are going to be providing a whole new technology to, let's say, the entire economy. And as far as I can tell, they haven't given $1 to somebody who's going to benefit from this technology. And I don't think we've thought this through down the road. Now, it may be that only those companies are the ones who benefit. There are stories of technological progress that do happen. For example, in the Industrial Revolution in England, only the real estate guys made any money because you can't think of you can't think of a single company that came out of the textile revolution of England, okay? So there, in San Francisco, too, by the way, Silicon Valley, real estate did really well. In any event, maybe just NVIDIA does well, but maybe there's a whole story of people using NVIDIA chips that are going to change the economy. So I just say, if AI is the business cycle, and that's right, these are early days.
And it has.